Morning, everybody, and welcome to the second Quarterly Bulletin of 2016. I think you know everybody here well, but just for the purpose of introductions, Luke Donner-Rand, Acting Head of Monetary Policy, John Flynn, our Head of Irish Economic Analysis, and Gabriel Fagan, our Chief Economist. So I'll hand over to Luke to give the update.
Thank you very much, and good morning. I will say a few words about the European and the international environment, and then give the ball to the Irish economy. Just as a summary of what I'm going to touch upon, the recovery of the euro area is continuing, but at very low pace. The downside risks to the outlook have been increasing in the last months. There is an issue of external demand and global situation, and there is a heightened level of financial market volatility that could also be a downward risk. Turning to inflation, inflation fell further, and inflationary pressures remain very subdued. Following these economic developments, the European Central Bank has been taking action on the 10th of March with a kind of a broad policy package that signals actually its determination to go back to the inflation objective. Let me turn to single points. In this chart, you can see the GDP growth in advanced economies in 2015. The green bars are the euro area, and you can see that potential growth has been below the pre-crisis level, and at the same time the output gap has been closing only partially, and this results in a kind of a moderate pace of growth. The international environment hasn't been particularly favorable, and that's one of the explanations. Advanced economies are also growing, but kind of mildly, and some emerging economies have been showing deceiving results. In particular, there's been a slowdown in China and very disappointing results in other economies such as Russia and Brazil. Let me show you something more specific. I move to the next slide. On the left-hand side, you have a kind of a snapshot of the global economy. You can see that world trade has been decreasing in recent months. Same thing for industrial production. And when we turn to forward-looking indicators, here we have the PMI new export orders. It's below 50, which normally is contractionary territory. On the right side, you have the indices of bank equities. So we focus in particular on the component of financial uncertainty that is linked to the banking system. We see that equities have been going down both in the United States, red line, and in the euro area, blue line. This is due to several factors, to the still high level of non-performing loans that have to be dealt with, to the low interest rate environment that somehow limits the profits of the banking system, and for Europe, to the entering into power of the Bank Recovery Resolution Directive, which basically implies bail-in of some bondholders of financial institutions, and that has somehow increased the risk aversion of the markets. Let me mention two other risks also on the downside. The first one is linked to the US economy. On the one hand, one could have lower growth than expected, and on the other hand, one could have higher than expected interest rates. This has a negative effect on dollarized economies in particular. And finally, there are a few elements of geopolitical tension. I will only mention the refugee crisis and the upcoming referendum on Brexit. I turn to inflation. On the left side, you see two lines. Headline inflation is the blue line, and it has been going down from 0.3% year-on-year in January to minus 0.2%. So deflation year-on-year in February. Now the HICP flash estimate for March seems to be slightly higher, but still negative. This is due to largely due to the effect of low oil prices and this slowing international environment. What is more worrying somehow is that measures of inflation excluding energy, that therefore closer to core inflation, are also going down from February to March from 1 to 0.7. This is the red line. If we move to the right chart, we see one of the mechanisms of this so-called second round effect. Basically, low oil prices reduce inflation, and low inflation reduces inflation expectations. This in turn means that the wages requested are also lower, and this kind of engenders a spiral of low prices and low wages. We can also see, if you look carefully actually, that there is a small blip at the very end in market-based measures of inflation expectations, which follows the intervention of the ECB on the 10th of March. So this intervention has had some positive effect on inflation expectations. A few words about the ECB Policy Package. On the 10th of March, the ECB has implemented a set of measures to show its commitment to going back towards the inflation objective. First of all, an interest rate reduction. The deposit facility has been moved down to minus 0.4%. The expansion of the APP, Asset Purchase Program, both in size and in scope. So the monthly APP has been increased from 60 to 80 billion per month, and the set of eligible assets has been increased both in size of existing assets and by the inclusion of non-bank corporations in the set of eligible assets. Finally, a new set of longer-term refinancing operation, TLTRO II, has been launched in order to facilitate the banking system in providing credit to the real economy. I conclude quickly with some numbers. This is a set of latest forecast for the euro area. On real GDP, the latest forecast, which is the Eurosystem BMPE, forecast 2016, a growth of 1.4% for 2016, going up to 1.7% in 2017. The risks are again on the downside. Turning to inflation, we see that the forecast is quite low for 2016, 0.1%. Actually, recent data would even point, would even point to lower number. On the other hand, there has been the intervention of the ECB, so here we are kind of in a more uncertain but kind of equilibrated risk assessment, and the numbers should go up for 2017 to 1.3%. I think I'll stop here. Thank you.
That's great. Thank you, Luca. So turning to the latest forecast for the Irish economy, then I'll talk a little bit about those now. So essentially, the main message from the bank's new forecast is that the outlook for the economy for 2016 and 2017 is broadly favourable. Growth has strengthened and broadened over the last 12 to 18 months, with domestic demand now firmly the main driver of the expansion in the economy. The strong momentum of domestic demand has been underpinned by relatively strong and broad-based growth in employment, and has also benefited from a pickup in earnings growth, and has also been reinforced by a further boost to purchasing power from lower energy prices. Now, the improvement in the labour market situation, which has probably been the most important factor in driving the recovery in recent years, has been particularly marked. If we look at the turnaround in employment fell to its lowest level in early 2012. And since then, we've seen kind of average annual employment growth of around just almost 2%, which has been a very strong performance. And the cumulative effect of that has now become quite strong. So initially, it helped to stabilise consumption, but now it's significant support to consumption and to demand more broadly in the economy. Now, in addition to the positive effect of those cumulative gains in employment, there are also a number of other factors which are tending to support demand in the economy. So, by and large, financial conditions still remain broadly favourable. The policy environment, certainly in comparison to kind of previous years, is that bit more benign. And then there's been some gradual improvement in the financial situation of households and firms. So, following GDP growth of 7.75% last year, our latest forecast is that we expect GDP to grow by 5.1% this year and by 4.2% in 2017. For 2016, this is a slightly higher growth forecast than we published in our last bulletin, and it largely reflects the impact of some carryover from the exceptionally strong growth last year and the strong growth in the second half of last year. Our forecast for growth in 2017 is marginally lower than the one that we published in January. Now, there are some risks to the forecast, and Luca has sort of mentioned, I suppose, some of these already, because they largely relate to external factors. So there are concerns about the global outlook and the possibility that growth in trading partner countries may turn out to be lower than is currently forecast, and that would be one downside risk to the projections. Another, I suppose, is in relation to the outlook for the UK, because the forecasts that we publish in this bulletin, as they always would be, are predicated on current institutional arrangements. So the forthcoming Brexit referendum then creates uncertainty and also is a downside risk factor. Now, if we move to look at the details of the forecast, sorry, I'll just click on there. So the details of forecasts are on that slide there. And turning to the details, as I said, for 2016, our forecast is for GDP to grow by 5.1%. Now, that 5.1% is 0.3% higher than our last forecast. I just want to check. Because actually all the other numbers are correct, bar that 5.1. Yeah, so that 4.8 should be 5.1.
You can circulate a new copy.
So we maybe circulate a fresh copy if that's the case. So as I said, our latest forecast is for GDP to grow by 5.1% this year, and that's 0.3% higher than that number that appears in that table. Now, the main impetus to growth over the forecast horizon is projected to come from the continued strength of demand within the economy, in the form of solid growth in consumer spending and investment. And we expect the main driver of that growth will be kind of the continuing recovery in employment and incomes. While we continue to expect strong export growth in 2016, the impact of this on overall economic growth is going to be offset by strong growth in imports. So we think that the net external contribution will be relatively minimal in 2016 and also in 2017, and that growth will continue to be driven by the strength of demand within the economy. Last year, consumer spending grew by 3.5%, which was the fastest rate of growth since 2007. And while some of that was a catch-up for weakness in consumer spending in earlier years, the main driver of growth, as I said, was the strength of the recovery in employment and in incomes. Now, while we expect the growth in employment to moderate a little bit over the forecast horizon, we still expect employment to grow solidly this year and next. And with earnings rising and with consumer confidence high, we expect these factors to support consumption this year and again next year. And there are also, particularly this year, there should also be maybe some further small boost from lower energy prices. So taking all these things into consideration, we expect consumer spending to grow by 2.8% this year, which is a little bit more moderate than last year, but again, a pretty solid rate of spending growth. Turning to investment, as you can see from the numbers there, while the growth in overall investment spending was exceptionally strong in 2015, as we've said before on these occasions, and as CSO have pointed out at the launch of quarterly national accounts, the overall level of investment in the economy is distorted by the impact of investment in aircraft and investment in intangibles, which is largely to do with the transfer of patents into Irish entities by some multinational corporations. Now, those two particularly categories of investment have been fairly volatile in recent years and have also been, particularly the investment in intangibles, have also become quite large. In terms of GDP, the investment in aircraft and intangibles affect both the investment and import numbers equally, so they net off in terms of their effect on GDP. But the scale of these flows obviously complicates the interpretation of the investment numbers and also the import data. And separately, it also distorts kind of measures of the composition of growth in the economy, and in particular, it overstates the contribution of domestic demand. So it also makes it difficult to forecast the overall level of investment. So in terms of investment, it's useful to think of investment separate from these two items. And if you abstract from that, underlying investment, as we call it, grew by 11% last year, which is pretty solid. So even if we take out these volatile items, investment is growing fairly strongly in the economy. And the forecast is for that measure of underlying investment to grow at double-digit pace both this year and next year. Now, if we combine that outlook for underlying investment with the other elements of domestic demand, then underlying domestic demand, if we call it that, grew by close to 4% last year, and we expect it to grow by around 4% this year, and to slow probably towards about 3.25% next year. So what that suggests is that overall domestic demand in the economy is going to grow pretty solidly again both this year and next year. Now, looking at the external side, if we look at what's happening to exports and imports, on the external side, both trade flows and factor income flows continue to be influenced by the impact of corporate restructurings in the multinational sector. So as a consequence, the growth of both exports and imports has been much stronger than previously projected. So if we look at last year, we have export growth of almost 14% and import growth of almost 16.5%. Now, on the export side, we've seen both solid performances in terms of services and goods exports. Services exports have grown strongly, particularly in the latter part of last year, and are benefiting from the increased royalties kind of related to the growing amount of intellectual property assets that are now being domiciled here. In addition, exports of the indigenous sectors have done quite well. So if you look at agri-food and tourism, they did quite well last year, and they've benefited from both favourable external demand and exchange rate developments, though more recent currency movements provide a less supportive environment for some in that case. Looking ahead, our expectation is that overall export growth will come to start to reflect demand more closely in trading partner countries over the forecast horizon. So we're forecasting export growth to moderate, but to still stay fairly strong. Now, there are some uncertainties there in both directions. As I mentioned, there's the uncertainty about the outlook for the global economy and for trading partner countries, which could be a weakening factor. But on the other side, then, we've seen very strong positive firm and sector-specific effects, which have tended to push export growth up. So again, there's some uncertainty over the outcome there. As I mentioned earlier, that overall, while we expect export growth to stay fairly strong, because import growth is also strong, the net external contribution to growth is going to be pretty modest over the forecast horizon. So it's largely going to be domestic demand that's going to be driving things. Now, again, for 2017, our forecast is for a slowdown in growth, but still a pretty solid rate of 4.2%. That's 0.2% lower than we forecast the last time. Again, the main driver is the domestic side of the economy. Again, it's coming from the growth in employment and incomes, although, as I say, we expect employment growth to moderate a little bit this year and next year. If we look at inflation developments have been pretty subdued over the last while, and that reflects the fact that the downward pressure from lower oil and commodity prices has continued to largely offset some higher services price inflation here. For 2016, we expect that pattern to continue. So our forecast for HSEP inflation for this year is for a rise of 0.6%, and that picks up gradually by about 1% more to 1.7% in 2017. Now, as I mentioned, the balance of risks of these forecasts, while the outlook is reasonably favourable and there's certainly strong momentum there, the balance of risks is probably tilted to the downside. Coming from the possibility of a weaker external outturn than is currently forecast. And then secondly, as I said, closer to home in the UK, the forthcoming Brexit referendum creates some uncertainty, which could also be a downside risk. So if we just move forward then, and I'll just say a little about the labour market forecasts. So our labour market forecasts are for a continuation of pretty solid employment performance. As I mentioned at the start, the labour market recovery has been ongoing for several years now, and we've seen fairly strong growth in employment. Last year we saw growth in employment of 2.5%, which was the equivalent of 50,000 new jobs, and the overall level of employment is now back very close to 2 million. We've seen a kind of more or less a 9% increase in employment since the trough back in 2012. The unemployment rate fell by 1.2% over the past 12 months, and it's now down to 8.8%. Given the nature of the recovery, the fact that the recovery has broadened out and is largely been driven by domestic demand, that should support continued job growth because it will tend to be more job intensive. We forecast for coming years, we forecast employment growth to moderate, but still to remain pretty solid at a rate of 2.3% this year and 1.8% next year. And that should tend to push down the unemployment rate on average to 8.2% for this year and 7.5% next year. But end year rates should be certainly lower than that, given that the trend is downward. So that concludes the overview of the Irish economy, and we'll pass out a corrected slide later.
Okay. Thank you very much, John. The forecast which has just been presented is a scenario. It is our best judgment of what is likely to happen given the available information. Now, like all forecasts, it's subject to uncertainty and subject to risks. And our judgment, as mentioned by John at the moment, is that the risks to this forecast are on the downside, stemming from the international environment and also in particular the risk of Brexit. So basically, whilst we have a very favourable central scenario, we have risks that are to the downside. That's an important consideration when thinking in terms of policy issues. Second consideration that we have to bear in mind is that there are substantial vulnerabilities still in the economy. Despite the sizable progress which has been made, we are still faced with quite significant legacies from the crisis, both in the public sector and in the private sector. So we have a context in which we have downside risk to our forecast and remaining vulnerabilities. And in that context, we would argue that's a context in which there is a strong case for precautionary behaviour, prudence, and to make sure that we make use of the strength and resilience of the economy to build up buffers to be able to deal with situations if adverse scenarios materialise. Let me just focus on three particular areas. First, in relation to the public finances, it's clear that we've seen very substantial progress in fiscal adjustment in this country. The debt ratio fell below 100% last year and is likely to fall further to below even the euro area average in 2017. So very substantial fiscal consolidation. And maybe over the medium term, to around 2018, we may be seeing even a balanced budget. However, their level of debt in the economy remains large. And that is a vulnerability in the event that there are adverse shocks which adversely impact on public expenditure and revenues, then the public finances are vulnerable. So that poses an issue in terms of ensuring that we have maintain sound public finances, sound fiscal policy. From our perspective, at a very minimum, one should like to see that the adherence to the fiscal rules of moving to a medium-term objective of a balanced budget in structural terms in 2018. But that would be the very minimum. We think it would be advisable and desirable to have somewhat more ambition there to build up more buffers to cope with adverse circumstances should they arise. In the private sector as well, we've also seen very substantial improvements in balance sheet positions. Just to give you one example, household debt has fallen from over 200 billion in 2008 to 151 billion on the latest data. So that's a very substantial improvement in the balance sheet of the households. However, relative to income, household debt is high by international standards. The Irish household debt to income ratio is the third highest in the EU. So basically even there we have remaining vulnerabilities. So again, the same logic, which would be that in order to, we think it's very likely that the deleveraging process that we have seen is going to continue for a while, and we think that's probably a welcome development because it will lead to a further strengthening in the household balance sheet position. In the issue of, thirdly, the issue of wages, it's clear we have seen significant developments. Wages fell by about 5% between 2008 and 2013 on the basis and the foot of the crisis. And since then, we have seen a pickup in wage growth, and wages are now expected to grow by 2.5% this year and next. Now, this type of wage growth is a normal phenomenon in a recovery. We normally expect, as the economy recovers, as unemployment falls, we expect some firming in wage growth. It is also a welcome development in the sense it has important function of distributing the gains of the recovery throughout the economy to employees, and therefore also tends to underpin consumption growth as well, along with employment growth. But even here, there is a caution. Caution is warranted. Ireland remains a relatively high-cost economy, so it is very important in this context that we avoid overshooting in terms of wage growth, which would lead to problems down the road in respect of competitiveness and in respect of employment growth. So overall, the message, the main policy message that we have is we have a favourable outlook, but there are remaining vulnerabilities in the economy, and there are downside risks to the economy. And therefore, this, from our perspective, suggests that it's advantageous to utilise the favourable outlook to further build the resilience of the economy, both in the private sector and the public sector, in order to better withstand adverse shocks. John?
Cheers. Thanks very much. Just to finish off by saying a little bit about we have 3 signed articles in the bulletin on this occasion, and the articles are the first one, which looks at Irish SME investment in economic recovery, is by James Carroll, Paul Mooney and Conor O'Toole, and it looks at how the SME sector, SME investment, has been performing kind of in recent years. And it shows that the share of SMEs investing has increased, that about 1 in 3 SMEs invest each 6-month period now, and that recently more smaller and domestic focused firms are investing, and also that most investment is now financed through internal funding. The second paper by Gavin Donnelly and Roisin Flaherty gives an overview of enhanced interest rate statistics for Ireland. And these are new statistics published under a new framework which was implemented across the euro area at the beginning of 2015. And it talks about the kind of what the data shows in relation to the statistics. The third article by James Carroll and Fergal McGann looks at understanding SME interest rate variation across Europe. And it looks at the extent to which SME interest rates vary across the euro area, the extent to which that's explained by SME characteristics, which they find that it's not explained by those as much, and the extent to which broader country-level factors tend to explain the variation. We have authors from all the papers available, so if you want to ask about any of those, you can do as well. So that, I think, concludes that.
Okay, we'll turn over to questions now. So if you'd just like to raise your hand with the microphone, Donald O'Donovan, the Irish Independent.
In terms of the big known unknown is the Brexit vote, obviously. Have you done anything to try and quantify what it might mean if the UK votes to leave the European Union? I suppose particularly around banks, because the two bank markets overlap quite strongly.
Yes, I mean, if you looked at our macro financial review, which was published in December, we had a box in there which actually presented the results of the analysis that has been conducted with regard to the impact of Brexit. not just on the economy, but also on various financial firms which are supervised by by the central bank, banks, insurance companies, and markets. So there is information there. The bank is engaged with the firms to make sure that the firms are taking appropriate measures to deal with the risks that may materialize.
But do you have a sense of how quickly the impact of that would have a material impact on the Irish economy?
Well, I mean, this is a problem, again, with Brexit. There are a lot of estimates out there regarding the impacts on the economy, and there are various complications there. First of all, I mean, even in the event of a Brexit, a UK vote to leave, there wouldn't be an instantaneous departure of the UK. There's a negotiating period which may stretch into many years ahead before the final arrangement. So in terms of timing of effects, it's very difficult to say that. And also we shouldn't forget maybe some of the effects are already there. So if you look at financial market variables, exchange rates, for example, in particular, you can already see some impacts of Brexit there. So that's in terms of timing. I don't think one can say much. In terms of the actual size of the effects, I think one can say almost even less, because it depends very crucially on the scenario that you envisage regarding the relationship between Britain and the rest of the EU. So you may go from a scenario where essentially there's very little effect on trade and so forth. It's almost like continuation of the current regime. I think this is the sort of, is that the Norway option that people talk about? Yeah. And then basically you go to another extreme where, Britain is out, it's a member of the WTO, and it's subject to those rules, which would be a major disruption to trade and financial flows in the EU. So depending on which scenario you want to go for, you get very big effects. But in any event, I would just simply say, I think it's unambiguous that the economic effect on Ireland is negative, would be negative. The question is how big, and that depends on which scenario you want to adopt.
Just on the specific
Sorry.
Sorry,
I do apologise.
Which is it?
the Irish Examiner.
Same quid Irish Examiner. On the 5.1%, what happens to that on June 23? If the forecast 5.1%, what happens to that on a June 23 vote?
Well, you have to tell me what happens to the outcome of the referendum, of course. In the event of a no vote, okay. Do you want to take that?
Well, I mean, in terms of the event of the no vote, in terms of thinking about Brexit, I suppose, as Gabriel says, you can see some of the effects now, but the effects tend to be in financial variables. The effects in terms of economic variables, it may be, the impact of those will be felt more in the longer term than immediately, because, as Gabriel was saying, the impact of Brexit will depend on two things. One, what is if the UK votes to leave, which we don't know until then anyway, but what would be the future relationship between the UK and the European Union, and then how does the UK economy evolve after that? The economic effects would depend on the extent to which Brexit would affect things like the free movement of goods and services, the free movement of labour, the free movement of capital. So we'll only know that not only after June 23rd, but then there's this negotiating period in which the arrangements between the UK and the EU are worked out. So there's a lot of uncertainty, obviously, as to how that may, if Brexit was to go ahead, how that might be, and how the UK economy might evolve after that. The sorts of channels through which we will be affected will be channels like, say, through trade, and particularly the sectors that will be exposed to the UK. Through the labour market, to the extent it would impact on employment, because that would tend to come from its impact on trade. It might have an effect on FDI, which you could argue could either be positive or negative depending on what happens. And things like that. There could be energy sector effects. So you can talk about the broad channels, but it's very hard to be precise about sort of particular effects.
Sorry, in the short term, a vote on June 23 to leave, does sterling collapse by 20-25%? And what does that mean for the 5.1% GDP growth? Which is a short term, what's the forecast?
Yeah, the main, if you look at what happens to exports and what tends to drive export growth, export growth tends to be mainly driven by demand in trading partner countries, and it's then affected by exchange rates, but the key variable tends to be demand in trading partner countries. Now, in recent years, then we've seen these impacts from firm and sector specific effects kind of become more strongly, grow more strongly. Now, if we're to see, if sterling was to weaken, then it depends on how do Irish exporters to the UK react to that. Typically, Irish exporters to the UK react, they're price takers. So they will tend to react initially, certainly, by narrowing their margins and trying to absorb what's happened. But to the extent that that happens, to the extent that they're able to do that, there are no volume effects. But to the extent that they're pressured into doing that, there may start to be some. So it's more likely if you were to see something on that, it would happen with something of a lag.
Paul Calpin from Reuters, and then Vincent Boland.
Just actually on that point, what kind of lag would you be talking about in terms of seeing a sterling impact on, say, the export numbers, and also just on a separate matter, in terms of the uncertain political outlook we have at the moment and may have for the next 2 to 3 years, depending on what happens, does that become a factor? Does political risk become a factor on the economy? Where might we see that have an impact, if any?
Well, I'll take the first one on the lag. On the lag, it's very difficult to say, and it's difficult to say as to whether the effect might be sizable anyway, because we've seen considerable variation in the exchange rate over time. So if you look at the exchange rate vis-a-vis sterling, say over the last 15 years, it has moved around a good bit, and Irish firms are now much better placed than they would have been back in the 1990s when the sensitivity to the sterling rate was much greater. So it may take a little bit of time to see the lag, and it may depend on whether there is a significant impact from it. The sectors that will be, as I say, that would be most affected would tend to be indigenous exporters that export significant amounts to the UK. So typically it would be the agri-food sector, clothing, footwear, typically sectors like that.
Okay, on the issue of the uncertainty, I mean, I think one, of course, needs to distinguish between political uncertainty in terms of who forms the government and policy uncertainty, what policies will be followed by the government. So we may have a lot of the first type of uncertainty at the moment, but I think there is less in relation to the broader contours of policy. If you look at the debate in the election where there was a broad acceptance of the framework of the European fiscal rules. But that having been said, what we should note is that up to now, we do not see major impacts on financial market variables or on the economic variables from the political uncertainty which is now being experienced. I think after the election result became known, there was a rise of 1 basis point in the bond yield spread between Germany and Ireland. So far we're not seeing major impacts. What would happen if this was likely to be protracted is another matter, and again, depending on what the nature of the uncertainty. So, I mean, in general, and there's an extensive literature on this which shows that policy uncertainty and political uncertainty is bad for growth. It is bad because it induces people mainly to postpone investments. So wait and see. Let's not buy a new car. Let's not build a new factory. And this postponement of caused by uncertainty has adverse impacts on the economy. So in general, I would say up to now we don't see too much in terms of actual data, but we should not take too much comfort from that to say that in a more protracted uncertainty would not lead to adverse consequences.
Yes, I had 2 questions, please. You say that wages fell by 5% between 2008 and 2013. I just wonder if you could give a little bit of more detail on that. And is that in the economy as a whole, or is it public or private sector? And the second question then is there's a lot of pent-up demand, certainly in the public sector, for higher wages and for big wage increases. What is the capacity of the economy to accommodate wage increases in the public sector and also in the private sector?
Well, the number to which I referred was the compensation per employee whole economy, so it includes both public and private sector. Regarding the second question, it's a little bit beyond the mandate of the central bank to set out a sort of a norm, if you like, for wages that is what is feasible given the public finances, the growth of the economy and so forth. That would be going a little bit beyond our mandate.
Any further questions? Paul again?
Maybe an additional one, kind of similar to the wage issue you mentioned. There could be challenges to competitiveness if wage growth is too high. On the housing angle, we're not seeing very much progress in terms of housing completions. And I think you've got economists saying it could be the end of the decade before you get to what's needed to keep up. Where are you seeing that at the moment, and how stark are the challenges in terms of our competitiveness and other impacts on the economy?
Do you want to talk about the investment?
Yeah, I mean, in terms of housing, the last year we saw completions kind of ran at about sort of 12,500, just over 12,500 houses. The forecast for this year, it looks like we see growth of about 18 to 20% in that, so we'll be looking at maybe 15,000 completions with 18,000 completions in 2017. So there are more houses being built, but obviously the issue is in terms of supply of housing. Like if we look at what's happening in the housing market, demand is being stimulated. Obviously there's demographics, there's the fact that the economy is recovering, incomes are growing, tends to support that. On the supply side, there are some kind of well-known and well-advertised constraints in terms of the impact of things like changes in regulations and things like that. So measures have been introduced to try and kind of stimulate housing supply, and they will start to have an effect. But it looks like there will still be a gap there for a period between sort of what actual supply will be and probably what is required.
Okay. Next question is to Donal O'Donovan.
Thanks. In terms of the supply of credit into the economy, the statistics out yesterday suggest that overall credit in the Irish economy is still in decline. At what point does that become sort of problematic? So is it a problem? Is there underutilization of credit in the Irish economy, and is that to do with availability, or is it to do with something else? And slightly related question, you have a box in the report on the REITs, the impact of REITs, and the capacity, the credit capacity, the underutilized credit capacity that they have. Just a very technical question, but are those REITs subject to the same macro-prudential rules that buy-to-let investors or are subject to?
Okay, I'll deal with the REITs. First of all, the REITs are basically, the macroprudential rules apply to residential mortgage lending. As far as I know, REITs are not engaged in that business. If they were to be engaging in that business, they would be subject to it. They lend to developers. They engage in development projects and so forth.
I think the REITs are big buyers of apartments, blocks.
Yes, but they are buyers, but they are not lending. They're not engaging in mortgage lending.
Right.
Their mortgage rules apply to the mortgage lending.
In terms of, sorry, I obviously misphrased the question. In terms of the credit available to those REITs, is the credit that's applied to those REITs, is that subject to those REITs?
Well, I mean, if you look at the balance sheets of REITs, they don't normally finance themselves by credit. That's relatively rare. They're mainly equity-based investments. That's the essential idea of the REIT, to allow people to invest in property without having to buy an individual property yourself. So I'm not sure that credit to REITs is a major issue, is an issue as such. In terms of the business model, it's not really credit rate based, and it's certainly not bank lending.
So is that no? So no.
I would not say. I don't see how the macroprudential rules have any material impact on the REIT activities of REITs. They're mainly in the commercial. Anyway, they're mainly in the commercial property. They can be in residential. They're financing themselves from mainly from equity, but also equity issuance, but also maybe larger debt rather than bank lending.
And then in terms of the underutilization, potential underutilization of credit in the Irish economy, is that a problematic level?
Well, I mean, you need to have a somewhat more nuanced picture regarding the credit situation. For a start, if we look at personal debt, we've noted that the debt ratio, the personal debt ratio, is falling. There is deleveraging going on in the economy. That's perfectly justified given the very high levels of debt that were there in the first place. So one would not necessarily want to see a boom and a return to the unsustainable debt levels that were seen in the 2008 thereabouts. So that's one element of the thing. If we actually look at the data, we can actually see now that there is some growth. While mortgage lending is still falling, we actually see some growth in non-mortgage, some of the components of non-mortgage credit, and that may be linked, for example, to the relatively buoyant car sales that are taking place. But the more general point is to what extent is credit constraint restrictions, credit constraint constraining growth in the economy? Well, I mean, if we think of an economy which has just grown by 7.8% last year, is due to grow by 5.1% this year. I mean, it's very hard at a macro level to make a case that, you know, the economy is suffering from severe credit constraints. And Connor's article, indeed, looking specifically at the SME sector, where he points to improvements that are taking place in that sector, an increase in investment, also highlights that. Mainly that investment, by the way, is being financed by internal sources, by own funds, retained earnings, and so forth. So again, I think one cannot make a big case to say that, you know, the economy as a whole at a macro level is being constrained.
Just on the issue, thanks, Fergal O'Brien, TV3. Just on the issue of mortgages, I know there's a review pending of the rules that are introduced by the central bank. Are there any plans in the wake of all the criticism that the rules have made it too restrictive for some people to buy? Any plans to change those rules or to drop the rules that were introduced?
Well, let me just refer you to what the governor said in a speech in January of this year, and basically it made a number of points. First of all, the rules are a permanent feature of the market, so the notion that the rules are going to be dropped would be fully inconsistent with that. So the rules are there for the long haul. Second point that he made is that there is a review underway. The bank is reviewing how the rules are functioning, mainly from the perspective of how they are meeting their objective of making household balance sheets and bank balance sheets more resilient to the property market. That's the main, we should never lose sight of what the main objective of the measure is. It's to promote financial stability in the economy and prevent a sort of recurrence of what we saw in the crisis. So that review is underway. He also pointed out that the evidence threshold for changes is high. So basically, in the event to justify a change, you need to have a lot of evidence that this is necessary. So that's a high threshold. And I think an additional point that was made was that one shouldn't necessarily think in terms of a change taking place. There may be no change, but there may be a tightening of the rules as well. There is no prior bias in terms of actually changing the rules or changing them in a particular direction. So that's the sort of current position at the moment in time. It is planned that the results of this review will be published in November. So the work is ongoing now as we speak. People are looking at a whole range of data sets, bank level, micro level, loan level data, macro data. A wide-ranging and comprehensive analysis is underway. It takes time to do that. It takes time to do it well, and that's ongoing.
I think the next question is for Dara Doyle here at the front.
Yeah.
You mentioned earlier on that central banks engage with the Irish banks on Brexit planning. How would you characterise their level of preparedness for Brexit? Do the banks have sufficiently detailed contingency plans at this point?
That's a very good question, but I'm afraid we're on the central banking side of the house. So I think that's more a question for the financial regulator. We're not as familiar with the precise details of what the financial regulator is doing. So that would be a question you could refer to the financial regulator. There will be, it's referred to the Deputy Governor of Financial Regulation. There will be an annual report press conference in April, and in April there will be a report also of the performance of the financial regulation. So that will be coming out. So I would suggest you refer more detailed questions regarding that to
and also to the SSM.
Yeah,
as well.
the SSM. Yeah.
What about the one question about how is the Irish economy in general, is it well prepared for something like Brexit? It seems to me, talking to companies, often say, well look, it's such an unknown, and what the relationship is going to be is so unknown. We can't really do much contingency planning, and you get that answer from a lot of firms.
Mm-hmm.
I mean, how do you characterise the wider preparedness of the economy for Brexit and political, economic?
I think it's something that has kind of loomed into view for a lot of people in more recently, kind of. So okay, it's been on the horizon for a while, kind of from when the referendum was signalled. It was signalled that it was going to be a referendum. I suppose the announcements of the date kind of concentrated people's attention. There seems to be a variation, certainly across firms. But certainly I think those that are involved and those who are more active in the UK market are certainly more conscious of it anyway. Yeah.
And Luca, what about the euro area? Do you get the sense that the euro area is ready to deal with Brexit? The information report is a big risk.
Yeah, well, it's certainly a risk. Whether there are specific preparations by firms and so on and so forth is something that a central bank cannot comment upon, I'm afraid.
But on a general sort of euro area economy, I mean, how?
I think here I would refer to the previous question. It largely depends, well, first of all, on the outcome of the referendum, and second, on the subsequent arrangement. There will be certainly a lag, because things will not be done in a non-smooth way, no matter what the outcome is. And second, there will be some effects through the exchange rate that kick in quicker, let's say within a year, and some other things that need more time. In terms of trade diversion and trade creation, or limits to mobility of people and capital and so on and so forth. There's no any specific contingency plan preparation going on at firms level, but I imagine that many of them, especially multinational corporations, are probably thinking about it.
Okay, thanks very much. And sorry, one final question, I think, coming from Maynard.
Sorry, just wanted to clarify. 5.1% bill growth, very roughly, in terms of extra taxes and exchequer in the year. What was your growth percentage growth? Is that translated?
Sorry, in terms of what that would mean.
Exactly.
Well, we've seen. I mean, it's on the basis of recent years. Kind of on the revenue side, kind of revenue has tended to outperform the sort of targets that have been set. The 5.1% growth, I think, would certainly support those targets that have been there, that were set kind of for this year, because it's slightly stronger growth. So it probably would make the targets that are set, it should make them achievable anyway, I would think.
And just finally on the SMEs, given the typical research, is it fair that Irish SMEs should be paying? I mean, why should the euro system work in such a way that Irish SMEs have to pay the highest loan rates in the Eurozone?
Well, just a few points. One is that it's, of course, the central bank and the euro system is not setting the rates for SMEs. The monetary policy sets money market rates. The question then is, what is the spread of the money market rates and how that varies across countries? So that's the question. Now, as we do have, as has been mentioned, quite significant differences in SME lending rates across euro area countries. And the question is then legitimately, well, why is it that Irish SME rates are so high relative to other European countries? And I think it's basically pretty much the same sort of issue that we had last year when we talked about standard variable rate mortgages. So we had the central bank produced a report trying to analyse that particular phenomenon. And of course, it shouldn't surprise you that it's a similar issue, because essentially it's the same banks, whether the bank is lending for an SME or the bank is lending for a mortgage. So in the analysis that was done at that time, I think it would basically come up with a similar sort of story. And the article that we have in the bulletin, I don't know whether Fergal wants to say something on it, but in essence it identifies similar factors that we had in the SVR report of last year. So issues like profitability, issues like risk default rates, the legacies of the currency crisis, and issues like competition. Is there anything you'd like to add on that, Fergal? Or?
No, I mean, I think I think Gabriel has covered the points there. I think it's just important to point out that it's not really for the central bank to say whether a rate is fair or not. It's merely that we would try to explore what are the characteristics of a country, of an economy, and of a financial system that might lead to the rates being higher. So I think Gabriel has covered the points: bank competition, default risk, a macroeconomic weakness, and a general perception of risk in the banking sector all seem to be associated with the SMEs paying higher rates across the euro area. We can't really say anything more than that as researchers or economists.
Okay, but maybe use a different word, fair. It shows that the ECB transmission mechanism, blah blah, isn't working. You know, discuss that is a central bank issue, isn't it?
Well, I mean, you're right in saying what we're seeing and what we have seen is financial fragmentation in the euro area. We've seen it in relation to government bond yields, which prior to the crisis were all very close to each other, and then we had a widening of spreads. We've seen it in relation to bank funding costs. Banks from different countries are facing different funding costs. We've seen it in terms of the rates that are charged by banks to their customers, whether it's for mortgages or SME loans or whatever. This financial fragmentation is there. It's not a desirable feature, and indeed the central bank has taken in the past, the ECB has taken measures to try and counteract that. If you think of the OMT program that was announced, was one example. The securities market program, a range of other instruments were trying to exactly address this issue that, you know, yes, you're right, when you get this fragmentation, the transmission mechanism is impaired. Can you address the impairment of the transmission mechanism? And the ECB has taken a number of initiatives to address that. I think it's fair to say that the degree of fragmentation in euro area financial markets has diminished significantly if you compare it to the time, say, of 2012, when you had all of this sort of breakup risks that were of the primary market consideration at the time. So there has been an improvement. But you're right, it's not desirable from a monetary policy point of view.
Okay, thank you very much. Just call out for any final questions. I think we're finished then. Thank you very much, and we'll see you again for the annual report.
Thanks a lot.
at the end of the year.